right, greetings. So I decided to make a quick video. I actually just got into a put credit spread on the SPX, which is the underlying that I've been trading over the last 6 to 8 weeks. Today is September the 21st. About a half an hour ago, the Federal Reserve just introduced or announced that they are increasing the interest rate by 75 basis points, which is essentially 0.75%. And so as a result, the market plunged. Let me just give you guys a visual here. So as you can see here, the market plunged right after the Fed. Let me move this side of the way. So right after the Fed announced that it was going to increase the interest rate by 75 basis points or 0.75%, the market immediately tumbled. But as you can see here, and that was around 2 o'clock. And as you can see here, the market has basically bounced back, and it has been on the rise ever since that initial significant decrease. So I decided to quickly put on a trade on the put side, right? Because a put credit spread is a bullish trading strategy, is a bullish options trading strategy, meaning that you are anticipating that the underlying, and in this case, the underlying is the SPX, is going to increase in value. So as you can see here, I sold the 3800 put option, and I bought the 3790 put option, which creates a spread, and I did that for 7 contracts. So the credit that I took in for that particular position is $210. And again, I keep it small. My goal is roughly between $300 to $500 per day, and sometimes, as you can see here, it's less than that. But the objective is to be consistent with making money on a daily basis. So here is the price of the underlying, right, conveyed by this circle here, and the actual value is 38.83, and my position is here, and so my position is considered out of the money, meaning that the price of the underlying is above my short strike on the put side of 3800 and my long strike of 3790 on the put side. So if for some reason the price should drop significantly within the next hour and drop below my 2 strike prices, then my position will be considered in the money. However, I'm going to watch it, for the next, 50 minutes or so before the market closes. And if it should happen to start to decrease significantly, then I would actually close out my position for a small loss. So I'm going to come back roughly around 350, 355 to give you guys an update on this particular trade. All right, so I'm back to give you guys an update. So I had to abort my position because, as you can see here, if I would have stayed in the position, then the price of the underlying would have basically breached my short strike of 3800, and so that would have been considered in the money. Excuse me. And so I would have lost money. Well, I would be losing a significant amount of money at this particular point. But because I recognized that the price of the underlying was coming down to my previous position and it was testing it, I closed that position out and I lost essentially $350 on that position. So if you recall, during the first segment of the video, I took in $210, but when I closed it out, because you got to buy the position back, so the position was actually more valuable than when I actually sold the vertical put credit spread. And so when you buy it back, you have to pay money, and if you're paying more than the credit in which you receive for selling your vertical spread, then you're going to lose money. So I lost $350. However, As you can see here, I got into a new position on the call side, right? I'm on the call side now because obviously the price continued to drop and decline in value. And so I decided to go on the call side because a vertical call credit spread is a bearish position, meaning that you make money as the price of the underlying goes down. And so I took in on that vertical call spread $175. So essentially, I erased half or 50% of my loss of $350. And so essentially, I only lost $175 on today. So not bad, not bad at all. But so yeah, the market was really acting very erratically because of the interest rate hike by the Federal Reserve. And so the market was really choppy. I probably should have stayed out of the market, but nevertheless, as a trader, I like to test the water sometime. And I got caught, so you lose money. That's part of trading. If you're not, if you're not willing to lose money as a trader, then trading is not really for you. So we got roughly 40 seconds before the market closes. So this vertical call credit spread, pretty much a done deal. So I'll walk away with $175, but keep in mind I did lose $350 earlier. So essentially I lost $175 on today. So not a bad loss at all. So as you can see here, the price is still falling. So this if I would have stayed in that position, this strike price of 3,800 would be considered in the money, and it's not quite below 37.90 yet, or well now it is. Okay, so now both the entire position would be considered in the money, and I would have lost basically on that position. I would have lost $6,000 had I stayed in it. So because I recognized early on what was taking place, got out of the trade early, closed it out, lost 350, but I put a new trade on the call side, took in $175, and so my total loss on today is not 350, but it's 175.